Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're answering a lot of different questions I get. Who is actually the best Nasdaq 100 ETF? Well, today we're going to start off with NEOS QQQI versus Goldman Sachs GPIQ. We're going to compare the yields, the fees, the growth potential, all in that Nasdaq 100. So we get this question a lot, and there's a lot of funds out there, especially in the way that the market has trended and that we're seeing tech is having a little bit of a struggle. But it's really, these two are actually built totally different. And I know a lot of people will jump on and say, oh my God, I want Goldman Sachs. And there's other people who are going to say, oh, always the NEOS package. But it's actually, these two are really built two different ways. And we're going to explain that today, so that you can understand completely. And I really believe, I don't even want to say that these are two that go head to head. These are two that actually can go hand in hand. Let me explain to you in today's video.
Well, right off the bat, I do this. Past performances does not guarantee future results. The information provided in this video is for educational and informational purposes only. If you are looking to do financial advice, always contact a financial advisor. As I am not a financial advisor, I am just someone who has been heavily into all of the retirements and working with the money.
First, we're going to pop underneath the hood of the Goldman Sachs NASDAQ 100 Premium Income GPIQ. The hardcore numbers of this fund, you got assets of $4.4 billion. So some very, very strong liquidity there. One of their big highlights is their expense ratio of 0.29%. Okay, they got 78 million shares outstanding. They've paid a dividend of $5.53 for a 9.60 dividend yield. Now, it does pay out monthly. And realistically, that price range is between that lately has been $57 to $58 with an ultimate high of $59.66. So when we look at the chart, we can actually see the fund has had, since April 2nd, had a major run up. Just honestly, this past Friday had its first major real drop down, but it's starting to recover already. So year to date, they're up 8.98%. Now, when I get into this, I want to tell you, this thing opened up October of 2023. So realistically, we're 2.5 years right now into the game. The performance-wise, year to date, total return 14.88%. Total return over 1 year 33.04%, and since inception 29.13%. So very strong, very positive type numbers. So the simplest thing that we can do, and this is just, I'm just doing simple, I'm going to call it simple math so we can see a better idea. If you have a fund that's taking a 9.6% yield, you remove that from the year-to-date performance, you're kind of getting an idea that you're getting some big growth from the fund with income, okay? Now, we take a look at the holdings, and there's a reason why we take a look at the holdings, because GPIQ does something different than what we're dealing with QQQI. It holds 106 holdings, okay? 45, almost 46% of its holdings is in the top 10 percentage. And when we look at the bar chart, what sectors they're into, you see they're heavily into technology. They have the consumer discretion, communication services. Then they get into consumer staples, industrial, healthcare, and so on. You can see that's pretty much built right around the NASDAQ 100. But here's the difference. They are actually owning the individual stocks. So they're paying the money into NVIDIA and Apple and Microsoft and AMD and Tesla. So they're putting it money into and actually owning those own stocks. So that makes some big differences. And how does it make a difference? Well, the Goldman Sachs GPQ design is the growth engine, the core of that NASDAQ 100 exposure. To capture the capital growth, GPIQ invests directly into companies that make up the Nasdaq 100. This gives the fund heavy exposure to the mega cap growth and the technology stocks like Nvidia, Apple, Microsoft, Amazon. When these tech giants rally, the underlying value of the fund shares rises, allowing investors to participate in the equity market upside. Okay? You've heard this before, is that with owning the actual funds, you can get some bigger upside. The income engine, the dynamic cover call, now this is another unique thing they do. It's a partial overwrite from between 25 to 75% of the portfolio. Instead of writing call options against 100% of its holdings, which caps the upside growth, the GPIQ dramatically sells call options on anywhere from that 25 to 75% of the portfolio based on market conditions. Adapting to volatility. When the market volatility spikes, the managers might write option calls closer to that 75% upward limit to collect the higher premiums. When the market is in a strong, steady bull run, they can scale it back towards that 25 to leave more of the portfolio uncapped, preserving room for the capital gains. So we call this a flex option. The fund utilizes the flexible exchange options, which gives the managers custom flexibility to choose precise strike prices and basically optimize the income strategy and the tax efficiency of the fund. Now, also the big number 3 is the supplement dividends. When a vast majority of the GPIQ's monthly distributions come from the options premium it collects, it also passes along that standard dividend payouts by the underlying Nasdaq 100 companies. So now the trade-off you got to keep in mind too is while GPIQ's adaptive strategy does a great job of preventing NAV erosion, the loss of principal value, that plagues the fixed percentage covered call funds. It is still a covered call fund and as an aggressive runaway bull market, its total return will lag slightly behind the pure Nasdaq 100 index fund of like QQQ. Okay, so in bull markets, it may lag a little bit. In volatility and flat markets, the higher premium acts as a cushion to outperform. Now let's take a look at NEOS, the Nasdaq 100 QQQI. Now this one has $12 billion in net assets, an expense ratio of 0.68%, so definitely higher. $7.60 in dividends or a 13.61% yield, paying out monthly. The dollar-wise, this thing's running in about the same range, $55 to $56 with a high about 57. Total returns is an interesting one. 9.93 for year to date, 25.86% for 1 year, and 20.71% since inception. Let's do that quick, simple math again. We're talking about 12% growth to a 13% income. Now we look at the year to date so far. It had that drop off like everyone you're going to see. We'll have 3.62% growth. So we can see that the growth is not as strong in QQQI as it is in JPIQ. Now when we take a look at QQQI's holding, you're going to see a lot of comparisons. 107 total holdings, 46% in the top 10%. Now you're going to see this a little more adjusted, 59% into technology, 13% into customer service or communication services, and consumer discretionary. You see a lot of the same exact names almost in the same exact position as you did with GPIQ. But you see the percentages off a little bit because they're a little heavier. They've moved a little closer to that tech side. Now they still hold the funds. They still hold the individual stocks. So that's, again, a great comparison between the two, that they both have that same ample covering of the stocks. Now the QQQI, now this is the NEOS high income side of it. The growth engine Like GPIQ, QQQI invests at least 80% of its net assets directly into the companies making up the NASDAQ 100. Okay, so they both have the similar application that they put the money into it. So if the tech rallies, the underlying value of QQI equity basket goes up. Now, the income spread, the call spreads, this is where QQI differs from the traditional cover call funds. Instead of selling calls, the managers execute a multi-layer active options strategy directly on the NASDAQ 100 index. Okay? So they're not just doing it on their shares, they're doing it actually on NDX, the index. It's selling call options on for premium. They sell out of the money or at the money index call options to generate massive monthly premium cash flow. Buying long calls to uncap the growth. QQQI's managers will also purchase out of the money call options. This acts as a safety valve. If the NASDAQ 100 suddenly skyrockets, these long calls trigger and allow the fund to capture more of the upward surge than the traditional covered call fund would allow. Now, the next thing is, I call it their secret sauce, is that tax efficiency and that loss harvesting. What really sets QQ apart from all the competitors is the focus on keeping more of the income after taxes. They use Section 1256 contracts, which writes those options directly on the NASDAQ 100 index itself, rather than individual stocks or on QQQ ETF. Legally, these index options qualify for 1256 contracts. This is why they do that. So when you look at 1256 contracts, you're talking yourself as a 60-40 long-term, short-term capital gains, regardless of how long you held the product. It's a massive tax advantage. Okay. And because it is actively managed, the NEOS team can systematically harvest losses on the underlying equities to offset gains again. This allows them to classify a portion of their monthly distributions as return of capital. So you have that double mix. You have that 60-40 plus you also get to use return of capital on top of that. So that defers the tax burden by lowering your cost basis rather than triggering immediate income. So already you can see how these two things operate totally different and why we see the higher income yields from NEOS QQI than you do from GIPQ. Now, is one saying one is better than the other? Not really. So the equity growth potential is a direct exposure to the NASDAQ 100 with the ability to capture more upside traditional. The way I'm going to put this is, again, in Doug's layman's way, is it owns these shares for growth. That's the growth engine, by owning the shares and letting the shares grow over time. Their income is going to dealing with the actual index, okay? So they're looking at the index side to do those cover calls. So they're not really even touching their assets, okay? They're actually using their assets to buy these covered calls and to do covered calls to generate the bigger income. So it's almost like you're playing on both sides of the fence. So that's what makes it a little bit different. Now, when we do a head-to-head comparison, first off, just from what we've seen, well, we got to go to the expense ratio. Goldman Sachs wins this one at 0.29%, no questions asked, because of almost a 4.4% difference in expense ratios. I understand it, and I'm not trying to defend one or the other, but I can understand the harder, the more difficult times that NEOS will have is going to have increased costs. I get that. Distribution yields, 9.4 to 13 to 14%. Well, that's going to QQQI for income. The option strategy, That Section 12 index, which is where they're, as we just talked about, they're doing the index options, while Goldman Sachs is actually using their actual portfolio. It's kind of a trade-off. It's kind of a, it's good, bad, back and forth. You can argue both sides of that fence. So I always kind of put that as a tie. Now, the capital appreciation, they're both looking for that higher upside capture. Okay, they're really trying to get as much as they possibly can. Tax efficiency, I really have to go with the QQQI for the tax efficiency because of the 1256 contracts and ROC, when Goldman Sachs is only using ROC. And just remember, ROC, a lot of people get this wrong. The return of capital, ROC, is a double-edged sword. It's a winner and a loser. If the fund uses it wrong, it's a loser because they're going to give you your money, literally, or give you your money back. They have an agreement to do that. If they do it right, they're actually helping you in your tax burden. So let's break down each one of these a little bit more detailed instead of just flying over the top. The analyst of the expense ratios. Goldman Sachs, as I said, wins this one hands down because one of the cheapest covered call ETFs available, providing a head start on total returns. Institutional scale pricing from the Goldman Sachs asset management, and significant advantage for long-term compounding of principal. Now, that 0.68 from NEOS, it's the standard expense ratio for actively managed boutique funds with complicated option strategies, approximately 2.34 times more expensive than GPIQ, and the management fees covers specialized tax implementations. So this means a lot. The numbers that we show, I already have this invested into it and so on. But you can see that more of your money is going into investments with Sachs than it is with NEOS. The option strategies, the consistent high yield overwriting on NEOS. Okay, they're using the index. I think I explained that fairly well, that they're using the index to do that. And why they do the index is that they can use the tax harvesting side of things. Now, the higher profile overwrite, the constant covers a larger portion of the portfolio to maintain that 13.5% targeted yield. And income first mandate. Their rules prioritize income monthly cash flow, creates the deliberate ceiling on the Nasdaq 100 price appreciation. GPIQ, it's using 25 to 75 based on market conditions of their portfolio. So this is why you see, and lately they have been the bigger, stronger growth factor. I know we haven't talked about that yet, but they are the bigger, stronger growth factor because we have pretty much, Nasdaq has been in a bull market. Okay, it's uncovered tech exposure that leaves significant portion of Nvidia and Apple uncovered to grow. And the total return focus that targets a lower sustainable 9.4% yield, allowing for the principal to grow. So what my point here is, you have NEOS that's dialing in on income first. Goldman Sachs is on growth first. So growth with income versus income with growth. Now, the capital appreciation and the growth potential, kind of just went through this a little bit, but it's a high consistency of overwriting strategy. NEOS is going to actively overwrite a larger, consistent percentage of the portfolio to sustain the maximum yield. They're doing everything they can to generate that income. While Goldman Sachs is really doing it the opposite. They're leaving massive portions of the tech stocks completely uncovered based on market conditions. I think this is the biggest difference between these two. NEOS is placing a ceiling on the stock price appreciation during aggressive tech rallies. Okay, so they're again focused on income, so they're not so concerned about growth, while Goldman Sachs is more about we want to get the growth factor across the board. And then the tax side of it, I told you, I lean more towards the QQQI. If you're in a Roth fund, if you're in an IRA, none of this probably really comes to effect to you. Unless when you go to sell it, when you go to sell it, your ROC is gonna definitely kick in. But if you're just into retirement, this is a bigger factor. QQQI wins with those 60/40, 12/56 advantage funds and using ROC versus just pure straight out ROC packages. Now, the key metrics that I go down to, this is how I would compare these to myself. Assets under management. The win goes to QQQI at 12 billion. We have liquidity with no issues, no problems. 4.4 billion from GPIQ. Again, you're now at billions. You're arguing about billions of dollars. Okay, so I'm not going to give a win one side or the other than QQQI has had a lot more investments put into it. The growth factor, 3.62% versus 8.98%. We had just explained why the growth is different from the two, and we also explained why the yields are different from each two, 13.61 to 9.6. So this is why you already see when I said at the beginning of the show, I said these two are not really head-to-head competition with each other. I think they could actually work hand in hand because I'm getting good growth or good income from QQQI, but I'm not getting the growth. And I'm getting good growth from GPIQ, and I'm not getting as good of yield, not double digits, from Goldman Sachs. We look at total returns, and on this channel, this is what I focus on starting off with. Year to date, 9.93 versus 14.88. 1 year, 25 versus 33, and since inception, 20 to 29. Where's those numbers differ? Where's the total returns come from? This is how you can take total returns and start breaking this thing down and looking deeper into it to try to get better answers to it. And again, we go back to it's growth and income versus income and growth versus growth and income. So these two are playing in two different avenues with two different total goals. So the verdict comes into this: when to choose QQQI. If you're living off of dividends like myself, it's ideal for retirees or investors who rely on a consistent high multitude monthly checks to fund their current lifestyles and daily expenses. The maximum cash flow priority is that raw, cold, hard cash and that tax sensitivity of that income. So really, it's kind of say if you want the best yield, you want to go to QQQI. Now, if you are a person who is, looking for that ultra low cost efficiency, you want that superior upside, you want to get as much growth as you can, and the principal compounding, well, GPIQ is best for growth-oriented investors seeking high income without sacrificing that tech bull market gains. So I would put GPIQ more of a person who is building towards retirement, who's not totally living off of dividends, who is really working the 3 to 5 years down the road that they want to start building towards. I would be in GPIQ. But once I broke that barrier line where I need income, and remember, biggest thing in retirement is not growth, it's income. That's the biggest thing that you run into, because this growth is great, but you got to sell to get the income. So here's my answer to you. And here's not my opinion, my choice, my true input across the board. I think these two work so well together that I would actually, and I do, have them both in my own portfolio. I have QQQI built into my income strategy. Okay, it is built into it. I want that big yield coming through. My GPIQ is actually in my growth fund. Now I'm still pulling the income off. Both Both streams are coming from income, but I'm not looking much for growth out of QQI. What I get covers inflation, great. GPIQ will help my fund grow and my portfolio grow for long term. Now, anytime I want, I could actually take the income from GPIQ and drip it and make it grow bigger. Now I'll have a bigger portion in QQQI because I need more income because I live 100% off of dividends. While I just want to cover the any flaws, any drop downs, anything that we've had negative, GPIQ is to cover. So QQI maximizes the raw amount of cold hard cash hitting my account every month, while GPI's lower and dramatic strategy ensures my principal to grow faster during tech markets. So this is how I use it. So when we say who wins in this category, depends on what side of the fence you're on. Are you on the income side or you're on the growth side? That's what makes these two so unique and so different. Now, I know a lot of you, put comments down below, Goldman Sachs all the way. I like my NEOS all the way. I love to hear that from you guys. I want to hear that from you guys. I want to see the comments coming in. What do you think? I may be the weird one. I use these as both. I've told you where I put them, how I work them, and these two actually work together. Let me know what your thoughts. If you like the presentation we've done, hit that like button. It helps the algorithm of YouTube with that. And also, if you haven't subscribed, don't be afraid to hit that subscribe button. We've added well over 1,000 new subscribers in the just past few days. So join the party. And also, if you want more information, always go to our Patreon. You can always get more information. It's free. You can join there, or you can support the channel. Guys, thanks a lot for watching, and please leave a comment down below.
Thank you for watching.